Gina, obviously 2015 will be a year, perhaps for most of those with investments on the NSE Securities Exchange will be hoping for better fortunes in 2016. And just to help us paint a picture of what happened at the stock market in 2015, I'm now joined by NSE Mwabesa, CEO of SBG Securities. Karibu sana.
Asante sana.
Now, 2015, almost 263 billion shillings wiped out in investor value from the NSE from 2014 to 2015. Perhaps I know at least of when we started in 2015, capital gains tax was a big issue for investors. But progressively through the years, over the second, third, and fourth quarter, perhaps what actually dragged the NSE Securities Exchange down that much?
Yeah, I think you're correct in that the first quarter of the year was dampened, activity was dampened by the introduction of capital gains tax. Yeah. Maybe not so much the quantum of the tax itself, but the whole implementation process, which no one had a clue what was going on, and so people sat back. Once we got around that, people started trading, but towards the second quarter, I think we were then affected by a weakening of the Kenya shilling, mainly because of the strengthening dollar across the globe. Yeah. And that started to erode returns for many of our international investors, who still constitute a fair, a large part of the market. Sometimes up to 60% of trading activity is carried out by foreign institutional investors. So that also dampened the market. In an effort to stem the sliding of the shilling, the monetary authorities then raised interest rates in Q3 or Q4, and that again hit the market because it was very difficult for local investors to even think about equities when they were getting 22% and above on 91-day to one-year paper. So I think those are the key macros that sort of dampened the market. But having said that, there were still pockets of value, and in spite of the 230 billion you've just mentioned, that value on paper written off, yeah. there were still pockets of value, and we know some investors did make money.
Quite interesting, 2015, where each quarter seemed to have its own unique challenges. Yes. But just talking about foreign investor participation at our exchange, perhaps, is it a growing concern, perhaps, that we need to have more local participation as well on the securities exchange, just to perhaps mitigate when foreign investors take capital flight and actually exit some of the investments that are made here locally?
Okay, I think two ways to answer that question. First, I think the foreign investors we're seeing in our market today are a lot different from the ones we saw maybe 5 years ago. That was the hot capital and was susceptible to flight when anything went wrong. I think what now we're seeing more is dedicated funds that want to invest in frontier markets, and in particular in sub-Saharan Africa. So those are the people who are coming to our markets. They have a reason. They are looking at value being created by growing middle classes in various economies, and that's why they are here. So they're here for the long haul, if I could put it that way. Yeah. Having said that, yes, I think it's important that the local component also matches up. Yeah. It might be difficult to match one for one because we're talking about investors that are coming from much larger markets with a lot more muscle and local, deeper pockets. That's the right way to put it. Yeah, but I think where we would want maybe the local institutions or local investors to sort of come to the market is in terms of not sitting away every time there's a downturn. I know we say 2015 was bearish. I would say maybe more neutral, because we know that there were pockets of value and people didn't make money, a bit sideways. In some cases, if you look at the bulk of the indices, we're talking about maybe a 11% decline in valuation. So I would say yes, it's important to have the local input or the local participation, but probably in the same manner that the foreigners participate.
Obviously, Kenya is one of those frontier markets that perhaps is more exciting than other countries. But just looking at it, 61 years or 61 or 62 years the exchange has been in place. If you just look at it and the way we are structured, if you compare ourselves to, I guess the only country we can compare ourselves to is South Africa, where are we in terms of deepening the level of participation, and B, even just the diversity of who's on the exchange, and perhaps even just offering different platforms for investors to take opportunities on?
Okay, I think 60 years in the development of capital market is actually not a long time.
Yeah.
If you look at some of the, like even the market that you mentioned, we're talking about markets that were formed in the 1800s. So not to make an excuse, but I think there's a natural progression through which markets go through, and I think we're getting there. We're starting to see new products coming on the markets. The NSE is now licensed to do derivatives, and hopefully we'll see a few of those coming in this year. We have a REIT listed on the exchange as of December last year. Granted, the market is small, and maybe that's also a mirror of the larger, of the macro space in you know, as far as GDP is concerned, etc. It'll be maybe unfair to compare ourselves to Johannesburg Stock Exchange. That is based on a very strong and large economy driven by mineral wealth and huge middle class. But I think we're getting there. I think I would say that we are on the right track, and hopefully we get there. We don't take another 100 years to get there. You know, yeah, obviously things should go at an exponential rate. But I think the point to make is also we need to probably really focus on regional integration. I think if you look at the Ugandan market where we operate, Rwanda and Tanzania, if we had one capital market serving those economies, because I think we then would see the economies of scale come through, and would have a much stronger market that could compete with some of the stronger markets in sub-Saharan Africa. But certainly, I think we're on the right track.
Obviously, it's interesting we're talking about that off camera, but just looking at that, even if you look at Uganda and even a market like Rwanda, it's basically more or less dominated by Kenyan companies there. Perhaps if you look at the region, perhaps there are some companies that are of interest and perhaps would play well if they were able to list on the Nairobi Securities Exchange. Granted that we've seen very slow listing over the last perhaps 5 years with a number of different companies and even other people deciding to exit the capital markets as a whole. But are there some companies perhaps that you in the region that you eye that perhaps would play a bigger role if they were trading on the Nairobi Securities Exchange?
Well, I think when companies are looking to raise capital, they should be looking for the where there's enough capital flow and or flow of capital and you know, cheaper capital that's easily accessible. So I think there are companies that would benefit from looking. I wouldn't want to say the Nairobi Securities Exchange because then we're starting to think insular. Yeah, but if we were a regional market, I think we would have more companies that would be able to access that regional market, as opposed to thinking that because I'm in Rwanda, I can only go to the Rwanda Stock Exchange, and maybe the flow of capital is not enough, maybe it's too expensive, it's difficult to get through, it's difficult to access, so I'll sit back and maybe look at another opportunity like private equity or something like that. I think we're doing ourselves a disservice by having these fragmented markets as a capital market, and I think we're all aware of that, but cutting through the bureaucracy, the red tape and everything is always difficult. But I think if we really want to compete on a continental scale, we need to focus on that integration.
Just looking at that, obviously you've alluded to it, and it's private equity. I mean, when the GEMS market was coming online, it was basically to allow some of the SMEs that are driving this economy to have a platform where they could be able to access capital. But now here we have private equity firms that are seeing Kenya as a very lucrative market, and some of them actually taking a lot of investment in some of these small companies coming online. Are you seeing it as perhaps a competitor to what perhaps will be happening on capital markets, or is it something that is also enabling growth of the region and companies in the region?
I think from a very basic review or point of view, it is competition for the capital markets, without a doubt. Private equity, I mean, there's an angle to it where it's complementary in that once private equity investors want to exit, they should be looking at the capital markets. But particularly for GEMS as a concept, I think there's a lot of competition there, because GEMS was designed to give venture capital, as it were, or early stage capital to entrepreneurs who have got great ideas and just can't access capital. Now, a lot of the PE funds that are operating in this region are targeting the same companies that would be targeted by GEMS. So certainly the concept has been challenged by the strong PE interest we see in East Africa.
Okay. Right. Let me ask you, just as we wrap up, 2015, close to, if not 12 firms, on the only firms that closed on a stronger position from 2014. One of the most surprising one for me was actually Uchumi, given what all the news that was coming out for Uchumi throughout the year. And obviously the agricultural counters, from I guess EGADS, all finished on a positive note. If you just look at perhaps 2015 and what was driving that, with an eye on 2016, perhaps are there opportunities, and perhaps what, if you look at your crystal ball from SBG Securities, 2016, is it exciting for listed firms?
I think 2016 will be, let me start this way. I think some of the challenges of 2015 will pertain maybe for the first half of the year. Certainly, as you just saw in the segment before this, there is a likelihood of interest rates going up, and maybe that will be because the shilling is still not, we're not certain that it's actually at the right position, or whether it's fairly stable. I think we might see some challenges also in terms of GDP growth, which might hamper, you know, the companies are actually performing or are in this economy in terms of being able to improve their fortunes. But I think the second half will probably be different, and we might start to see more companies improve their revenues or their business, and that's mainly because I think we'll just be almost a year away from the 2017 general election. And I think the new government fiscal year will unlock funds that will go into infrastructure development, capital investments, both at the central government and the county government level, mainly for the politicking or campaigns. So I think that the companies that are able to adapt, or leverage, be in that value chain, whether it's your tier 1 banks that have got good networks across the country, whether it's your infrastructure play, so your, you know, maybe cement sectors, etc. I think will be able to tap into that. So they could have a better second half going into 2017 as well, with this increased flow of funds.
All right. Many thanks. That has been Gamba Mwabesa, CEO of SBG Securities, is telling us about what to look out for perhaps in 2016, and just reviewing what 2015 was all about at the capital markets. Now we take a short commercial break, but don't go too far. When we come back, Abia will be telling you more about FastJet and all that important conversation about what BRIC is doing. They got 300 million shillings. So what are they going to be doing with that money? Is it going to the educational sector, or how exactly? Have they tendered for the laptop project? Eric Hausman is going to be here telling us more about how that is going to pan out, so don't go too far.